Hello guys and welcome to my YouTube channel. So today I'm just doing a video on investment tips for beginners, which a lot of them come from Warren Buffett, but a lot of others come from other investors as well. But a lot of people tend to hail Warren Buffett as, the greatest investor of all time. Last time I did a video on my thoughts on Warren Buffett on some of the things which he said, which to me don't make a lot of sense for the average investor. So this video is to counteract that and sort of show some of the things that he does say that do make a lot of sense, as well as add a lot of tips which I have heard from other people as well. So as long as you know the basics of what a stock is, this is just a very, it's a beginner video, so it's not going to cover like very complex things to do with stocks, such as the difference between a fundamental and a technical analysis. That will come a bit later. But I just wanted to give a very brief tip for beginners. These are things which I wish I had known, right? So just starting off with myself, uh, when I was a very young boy, maybe 13 or 12, I'd heard about stocks, right? And I live in Nairobi, Kenya. So, there was someone, I don't know who it was on the TV because I didn't have internet at the time. I don't know who it was, but someone was saying something like, oh, instead of buying candy or something, you should buy some stocks, right? Either buy some stocks or buy some piece of land, right? The whole concept or the whole principle of putting your money to work for you, right? So also this video isn't really gonna cover like, brokerage fees or platforms which you can actually use to buy your stock, because that's very subjective. That literally depends on what country you live in, and I kind of think that my audience is very global, but I will cover those in future videos. I'll try and cover some of the best international platforms to use to invest in stocks. So when I heard that, right, I used to sometimes read the newspaper, not always, but I think the page that had a list of the stocks, right? The page that had a list of the stocks was close to the page that had the movies. It showed which movies were in theater. It had the Sudoku, the crossword, and it also had the TV show schedule, right? So it wasn't too hard for me to find that page. And I knew nothing about stocks. And even for my parents, they said they lost a lot of money in stocks. They didn't bother to go into the details. They just said they lost a lot of money, like, maybe long before I was born. So, like, maybe in the 80s. And after that, they they never looked back, right? They're like, stocks, never again, right? Never again. Yeah, so basically, I didn't have anyone who could sort of enlighten me as to how to go about investing in stocks. So, of course, I just tried to use like a logical approach, like a basic approach. So, there's this company called Eveready, and this company sells batteries. So, this is the company, Eveready East Africa Limited, and the stock is literally 1 Kenya shilling. Now, back then it was 10 Kenya shillings. So that is very low. Like, 10 Kenya shillings is basically 10 cents. So 1 Kenya shilling is literally 1 cent. And you can see how the stock has basically performed uh, over time. It's kind of gone up, gone down. I guess maybe it's a good thing that I didn't buy it. But essentially, my reasoning at the time was simply, oh, I can just buy a very simple stock, right? Like a cheap stock, penny stocks. Well, I guess in this case, literally penny stocks. And, I'll probably make a lot of money because the stock doesn't have to move that much for me to make money, right? Because if a stock tends to fluctuate from let's say $2 to $5, wow, that's definitely a lot of money. So that was my plan. It's just at the time I didn't really know much about how to deal with the brokers and the fees involved. So I just never got around to it. But long story short, that was just the extent of my investment knowledge. And later on, as I said, I read books on investing and then books on real estate, but I still didn't know that much about investing. But then I also heard about crypto, right? Which leads me to another segue, which is the continuation of the last video I made on Warren Buffett, is that Warren Buffett tends to be extremely bearish on crypto. I can at least explain the difference between bull and bear. So if you're bullish on something, like a bull charges towards something. If you're bearish, a bear hibernates, it goes away and hibernates. So are you aggressive? Like, do you believe the stock will go up? That's bullish. Bearish, you believe the stock will go down. So if you're bearish, you normally either you don't invest or you sell all your positions because you believe it's going to go down. If you're bullish, you invest a lot of your money because you believe it's going to go up. So, yeah, Warren Buffett is also very bearish on crypto. And that's why, again, I'm saying that I'm not sure if his advice necessarily tracks very well with uh, the average investor, because if you asked Warren Buffett in, is it 2008, is that when Bitcoin came out? If you had asked him either 2008 or 2011, around that time, if you had asked him, oh, should I invest in this Bitcoin, it's going for like what, $1, you'd be like, oh no, yeah, you might as well throw away that money. You're better off investing in what, Coca-Cola or Nike. You're better off investing in Coca-Cola and Nike. So this is Bitcoin. It's currently at 41,975. And if I just go back, there was a point it was, let's say, 388 in 2014. So this is literally 100 bagger, right? There's a book called 100 baggers. I can't remember the author, but these are, once in a lifetime companies that give you 100x returns. And of course, we know that Bitcoin was cheaper. But let's say maybe you weren't so gullible. Let's say you're like, oh, I'm gonna wait till this thing really picks up steam, and then you're like, wow, this thing is going for $300. Man, I should really get in on this, right? So you go, you sit down, you talk to Warren Buffett, and you're like, hey, what do you think of this Bitcoin thing? Should I invest? And he would have said, no, you should invest in Coca-Cola. So now this is Coca-Cola, right? Macro Trends is a very good website because you can see everything there, right? So, I don't want this video to be too long, but basically, if we look at, say, oh, I messed up the chart. What have I done? If we look at basically 2014, right? It was at 33. I don't know why this chart is doing this to me. Huh. Let me just zoom in a bit. If we look at 2014, it was $33, and now it's going to $60, right? This is a chart of Coca-Cola. Yeah. So basically, my point is simply that if you invested in Coca-Cola, you'd have gotten double your money. If you invested in Bitcoin, you'd have gotten 100 times your money. And we know there was a point Bitcoin was like $1 or $15. But this is the assumption that it was at $300. Like, you really were skeptical and you really waited to jump in. So my point is simply that there've been a lot of Bitcoin millionaires, but there haven't been as many uh, millionaires who follow Warren Buffett. Only a handful, like only a few specialized people who start hedge funds and stuff like that, but not very many of the average Joe. So that's why I'm saying sometimes his advice doesn't necessarily track with the average Joe. That being said, these are the tips which I had wanted to get into that I would say have boosted my knowledge about investing. So, rule one, absolute rule one is never short stock. What is shorting stock? It's kind of complex to explain without any diagrams, but the basis is that you kind of borrow stock from your broker, he credits your account with money, and he sells the stock on your behalf, and then you agree to give him back the stock. So it's kind of like the opposite. Normally, you you buy a stock and then you sell it. This time it's like you're borrowing a stock, it's sold for you, and you agree to buy it back, right? So let's say there's a stock for $1, right? You agree to borrow that stock and he credits your account with with 100, I mean with $1, as well as the fact that you own that stock, right? And basically you sell the stock. Um, so shorting stock basically means you believe the value will go down. So if it goes down to like 50 cents, you can buy back the stock, give him the stock, and you keep the change. So basically, he sells a stock for you at $1, and you buy a stock when it crashes at 50 cents. You give him the 50 cents, you stay with the 50 cents, right? So you've made money by shorting the stock. The problem is if the opposite happens, you are screwed. If the stock goes to 1 million or 1,000, you have to buy the stock, right? You have to, because he sold the stock for you, you have to buy it back at 1,000 and give him back that one stock when it's at 1,000. So you'll have lost $999. You can just watch videos on shorting stock explained, or just videos on GameStop stock, what happened during that fiasco, how people made money, right? And how hedge funds lost money. So shorting stocks, just never do that. Like literally never do. Like never short stock. Ever. Ever. Like literally, like just never short stock. Like that is the worst thing you can do, because you can literally lose more than you invested. You can invest $1,000 and you get charged $1 million, which I think is crazy. By the way, guys, leave comments if you want my videos to be longer or shorter. Yeah, but basically shorting stock, it's an easy rule to follow. Just don't get too greedy. The second rule, which is kind of similar to rule one, is never borrow money to buy stock, right? That's pretty straightforward. Stocks, people kind of say it's like gambling. That's not 100% true. But in a way it is. So it's like borrowing money to gamble, right? Just don't do it. Don't borrow money to buy stocks. And I think if you follow rule one and rule two, those are the major don'ts, then I think you'll be okay for the most part. Like you might lose money, but you'll never lose more than you own, right? Right. So now that's how to not lose money. But now the question is, how do we make money? So one of the rules that Warren Buffett says, which everyone agrees on and resonates with me as well, is only invest in companies you understand. And when I said last time, I meant that it's when you understand a company, it's not just how to use its product, right? But it's about understanding where the industry is going to be in the next 10 years. So that's why Warren Buffett invests like in Coca-Cola or in Gillette, because he's like, 10 years, 50 years, 100 years, people will still drink soda, people will still need to shave their beards or their legs, right? And you see, I wasn't necessarily thinking about that back when I was 13, trying to buy that ever-ready stock. They manufacture really cheap batteries, like AA batteries. I wasn't really thinking about that. I was just thinking, what's the cheapest stock I can get and hoping that it'll go up. And guess what? It actually went down, right? So basically, that's the first principle, which is invest in companies you understand, because don't think of the stock as just a piece of paper. Think of it as owning a piece of the business, right? Think of it as you needing to work in that company. Like, think about it as if you owned all of the stock in that company, right? Basically, only invest in companies you understand. And when you look at it through that lens, you start to understand why tech companies can be quite volatile, especially app companies. So, for example, Snapchat, where is it going to be in 10 years? We don't know. Well, Facebook is kind of big, so I don't really think it will crash. But some of the apps which we use today, we might not use them in 10 years. Like MySpace crashed. Some of you are not even old enough to remember MySpace. Like, I never used MySpace. I just heard about it. I just watched comedy movies, like 2002 comedy movies, and I saw MySpace, but I've never used it myself. So, that's the other tip, that I think tech app companies can be volatile, but basically invest in products and companies that you know. So, what he said is that if you if you're if you're a chef, maybe you've been in the industry for 20 years, yeah, invest in Pizza Hut, invest in Domino's, invest in Burger King. Those are the kind of stocks you'd invest in. If you're a doctor or a pharmacist, maybe you can invest in those biotech companies or those pharmaceutical companies, right? So I think for us, it wouldn't necessarily be a smart idea to invest in pharmaceutical companies because we don't necessarily understand that much about them. Like, yes, we understand they have long-term sustainable competitive advantage, meaning people will still use their products, but I would say I don't really know that much about pharmaceuticals. So if it were me, they wouldn't really make up a large percent of my portfolio. Yeah, so just think about products that you use every single day that aren't going to stop being made. So for me, the one product I really think of a lot is fridges, right? Fridges, nothing has changed since 1950. Unless they make a super preservative, we're gonna be using fridges in 2050, right? Try and think 30 years into the future, what will people still use? So fridges, ketchup, hot chocolate, maybe light bulbs, right? I think they'll still use light bulbs. Computers are tricky, we're switching more to virtual reality and maybe more of tablets. Like, I think TVs also are not that good because before everyone used to use TVs, but I think now we spend maybe like what, 50% more of our time on laptops. I think, like Netflix, for example, it started out mainly as like a laptop application, right? So I think TVs have started to lose their competitive advantage. So if I had stocks in TV companies, I would move them to companies that manufacture fridges. And that's the other thing. Like, if you think about Netflix, for example, I don't know where Netflix will be in the next 10 years because literally now is not a good time to invest in Netflix because every company is starting to do the same thing. There's HBO Max, there's Disney Plus. There's a video on YouTube that says now is literally the cheapest watching TV is going to be for you because every company is going to get their own material and have their own platform for you to watch. So you won't get as many shows on Netflix, like HBO Max has taken away from what could have been on Netflix. Disney Plus, you can't watch all of the Marvel shows on Netflix anymore. So Netflix is a good example of an application which has kind of lost their competitive advantage. I would be a bit bearish on it, right? Second is invest during the dip. This one comes more from real estate. Like, really, the economy follows boom and bust cycles every 10 years. If you follow economic crashes, there's usually a crash every 10 years, right? So invest when things are at the bottom. You have to wait till things are at the bottom. And then when you start to see it tick up, that's when you invest. But don't sell. Don't sell during the dip. That's the biggest mistake everyone makes. They sell during the dip. Don't sell. Don't panic. Don't panic. And do not sell. No matter what, never sell during the dip. Never. Unless you're sure the company is going to crash. But if you're so sure it's going to crash, you might as well short it. Like, ask yourself this. Are you so sure that this company is going to crash that you're willing to actually short it with $1,000 and risk losing $1 million? If you're not, then don't sell. Next is the people who look at the screen every, like 3 seconds to see if stocks will go up and down. Those guys don't really make money. If you want to make money in stocks, I would say Warren Buffett advises hold stocks for 5 to 10 years, right? Focus more long term. So, in other words, don't quit your day job, hold the stock, wait 5 to 10 years. And next is also you should invest in index funds. So, I explained that an index fund is like you have the S&P 500 index, which is a list of the top 500 companies in America. And basically a hedge fund buys positions in each of those companies, packages it and cuts it up into small pieces. So you can basically own a fraction of each of these companies for like a very low price. So a single stock might crash, but an index fund is not going to crash. So, yeah, really just look up index funds, and definitely, if you're a beginner, the first stock you should buy is an index fund, hands down, an index fund. Buy it and forget about it. Buy it and just keep putting money into it. If you're the kind who likes to put money in the bank, just put it in an index fund. You will average 10% returns annually. A bank can give you maybe what, 2% interest, and that doesn't really keep up with inflation. So yeah, you're gonna, 10% compounding. So $1,000 this year, 10% of that is 110. So next year it's 10% of 110. So you'll get like 210. Not 210, you'll get 1,210, right? So it keeps compounding and has that snowball effect. And people say compounding is the eighth wonder of the world. So, yeah, if you're passive and you don't want to think about stocks, just basically put all your money in an index fund. That's really the best advice I can give you. You also have REITs. REITs are real estate investment trusts. So imagine you have a company, right? And the company owns some real estate, right? So company A owns a lot of malls, company B owns a lot of resorts, company C owns a lot of offices. Now imagine if a hedge fund comes along, buys positions in company A, B, and C, packages them up and cuts them up and gives them to you. That is what a rate is. Now, historically, rates have had slightly lower returns than the S&P 500 index funds. So, you get 10% for S&P 500, but you only get 6% for the rates. But in terms of diversifying your portfolio, rates are a must have, because instead of you going and buying real estate, right, where you're chasing tenants, you're fixing electrical wiring, fixing plumbing, repainting the house, fixing broken windows, you can just invest in rates, and you have companies that have 100 MBAs managing world-class AAA properties that now belong to you. You own a fraction of them. So you can sleep easy knowing that probably the mall that you shop at is probably in your portfolio. So yeah, I definitely think rates are better. I think if someone wants to get into real estate, because I think I covered rates. If I didn't, basically a rate is, the advantages are, one, you can get in with little money. So for example, in Kenya, you can't buy a house with one point with unless you have like 1 million Kenya shillings, which is like one, is that $10,000, right? So if you want to get in with like $5,000, you can't really buy a property for rent. You also won't have to pay mortgages. And when it comes to selling, if you're in a crisis, you can you can basically sell some of your rates. You don't have to sell, like, if God forbid, like if you're in an emergency that's not related to the market, right? So a medical emergency and you're dead broke, all you have is a house. Houses are not very liquid, so it will take a long time for you to sell the house, and you have to sell the whole house, right? Like if your house, I'll just use Kenya shillings. If your house is worth like 1.5 million Kenya shillings and you only needed 500,000 Kenya shillings, you still have to sell the whole house, right? But with the rates, you literally only sell as much as you need, and you sell them with literally the push of a button. You don't have to struggle to find agencies to sell your house, pay them the commission, pay lawyers the fees, none of that icky, messy, complex stuff. You just press a button, you sell your rates, you keep what you need. Sell what you need, keep what you need. So very clean, very simple, easily divisible. Definitely what you need to get into, right? Rates have huge advantages. It's just real estate may have slightly higher returns. Like some rates can give you 10% returns, but if you're renting at 1%, then you should get 12% annually, assuming your tenant doesn't skip out on you, assuming the mortgage is already paid off, assuming a lot of assumptions. Assuming you don't have to repair buildings and such, assuming you're not paying a manager to look after the property. You get what I mean? So a lot of fees can eat into that 12% annually that you get, whereas the rate, you can get a rate, or REIT, they're called REITs, not rates. REITs, you can get a REIT for 10%. So yeah, definitely invest in some REITs. And finally, what happens during inflation? Because America is going through a lot of inflation. And what have you heard, right? What have you heard? I'll give you 5 seconds to tell me what you've heard. You've probably heard, when shit hits the fan, when things go bad, what do you do? When the economy is gonna crash, invest in gold, right? Invest in gold. Well, investing in gold is a very old school way to do it, because guys are like, yeah, you need to hide gold under your bed. These days, we have what are known as commodity ETFs. So basically, index funds, but an index fund is and an ETF are kind of the same. The only difference is an ETF, which is an exchange traded fund, can be traded anytime during the day, as long as the stock market is open. But an index fund can only be traded once a day. So really, index funds are better because they have lower fees and we're long-term investors. So we don't trade every single day. So we don't need that flexibility. But you have a lot of commodity ETFs. So commodity ETFs are, again, they're like index funds where a company goes and buys positions in each company. So you have like gold, copper, silver, platinum, corn, soybeans, right? So agricultural ETFs, I mean agricultural commodities, as well as physical metal commodities. So this is equivalent to keeping gold, platinum, silver, copper, corn, soy, wheat under your bed and waiting for the apocalypse and waiting for people to either need food or need metals, right? So pretty ingenious. And the reason you want to buy commodity ETFs during inflation is because as inflation goes up, these commodities are actually going to go up, right? Because these are essentials, like gold and copper, those are used in technology. I think there's a current crisis with China. I don't know if it's over. The manufacturing the chips, the computer chips, I don't know if it's over. And corn, for example, food prices. This is really the flip side of investing. This is really that knowledge, that secret knowledge that puts you in a different league above other people, right? So many people are there complaining. They're like, oh my gosh, food prices are rising. This is crazy. This is terrible. But we can be on the other side of that. Us guys can be like, yes, food prices are rising. That's good news for us, right? It's good news for the investors. So really, I think Robert Kiyosaki was right. Like his video was the one I watched, which really highlighted that people, billionaires and millionaires, know how to make money during a recession, during a downturn. That is the best time for them. For other reasons, he didn't mention commodity ETFs, but he inspired me to look into how can people make money during recessions or during inflation. So inflation, what happens? Everything goes up, right? Commodities. There's some energy commodities as well. I believe people who produce electricity and such. So you're like, damn, my food is going up, my water is going up, my electricity is going up, right? Meanwhile, we need to be on the other side of that. We need to be saying, yes, the corn is going up, the wheat is going up, the gold is going up, right? So yeah, this advice is really meant to just take us to the moon, take us to that next level, right? The people, when I read this, one of the books I mentioned in the 60 best books to read, I thought it's crazy that millionaires, billionaires, and janitors or waitresses or average people, they walk the same streets. Not all the time, but if you live in New York, you live in LA, you're walking on the same street as a millionaire, right? The only difference is his mindset, right? You're living in the same place as him, but that guy or that girl, he knows something that you don't, right? So really, these are the things that blew my mind, especially the commodity ETFs. But just know with the inflation, the the it's linked to the commodities. So if inflation goes down, commodities will also go down. So the idea is to switch between commodities and regular index funds or regular stock. But yeah, basically, those are my beginner tips for investing. I thought this video would be 20 minutes. But yeah, I think if you really understand that I have saved you maybe what, 10 hours? I've saved you maybe 10 hours and two books on investing, and you're off to a good start. In fact, you don't even need to read any books or anything. Just look up these videos, right? Find out about the index funds, the ETFs, the REITs, and start investing, start tracking down your companies that you like, and yeah, start investing, start holding. Because I guess probably rule 7 is, as I mentioned earlier, don't quit your day job. Don't quit your day job, right? Don't quit your day job. Just invest on the side. I think those are the guys who actually make the most money. Day traders, I would not be a day trader. I definitely would not. Like, making an income from day trading, you might as well be a musician or an artist, or I don't know, a fire juggler or a yodeler. I wouldn't do that. Like, frankly, I think it's a bad idea to get into it full time. I think it's a better idea to have a job, put your money on the side, don't put it in the bank, put it in the stock market. And yeah, that's why a lot of people are deterred. They're deterred from uh they're basically deterred from investing in stocks because they think they need to be glued to a computer and trading every day. You don't. You literally don't. There's active and passive investing, and I think passive investing is the best way to go about it. So yeah, those are my tips, and good luck and happy investing.